We're in the middle of a historic bond rise that's being watched around the world. That's what we mean when we say globally synchronized, big moves everywhere. Treasuries have done very well, and rates in Europe have dropped a lot. See what's going on in China, though, if you really want to see something amazing. There are a lot of record lows, even though the central bank is working hard to make things better. Rates that are too low are usually a bad sign, and the Chinese government knows this. Everything they can think of is being done to stop the bond rise, but it hasn't worked yet. With rates that are so low, they're setting the stage for a downward shock that can already be seen in many places in China, not just in producer prices. If you haven't already, consider subscribing to the channel. Hit that bell icon, and we will make sure you'll stay updated on all the latest global economy news. Chinese 10-year yields hit another all-time low this week, and the People's Bank of China has been selling bonds, but not the ones they said they would short sell. The 2-year bond yield is almost at its all-time low from April 2020, which isn't a great measure when you think about some of the worst economic times in the world's history over the last 40 years. Chinese banks are making it harder for people to borrow money. That's why they're buying bonds instead, which is like taking two risks against the government's plans, or lack of plans. The amount of credit given out in August was the lowest since 2016, which adds to the list of bad matches for this century. Even though efforts have been made to boost the economy so far, President Xi Jinping said that China probably won't reach its small growth goal for the year. Chinese prices are falling like a rock and have hit multi-year lows. The figures on jobs and wages are starting to point to the worst-case scenario. This could lead to the kind of deflation that the bond rally has been pointing to the whole time. The hope of more stimulus, which, let's be honest, never really seems to do much other than give short-term boosts, might give markets a little sugar high in the short term. The Chinese stock market is a great example of this mess. Early this year, investors believed all the hype about big plans to save the housing market, boost the economy, and help with everything else. But now the truth has come out, and it's not pretty. Bond prices are going down very quickly, and the stock market is also going down. The Shanghai Composite Index was back at 700 on Friday, a number it hadn't seen since early February. In short, it has lost all the progress it made earlier in the year. The original recovery was helped by positive predictions about what the government would do to help different areas, but it's becoming clear that these plans didn't really happen. The stock market is going back to where it was, and it could even go lower. President Xi Jinping seemed to agree that the economy isn't doing as well as planned. In Lanzhou, a city in the northwest of China, he told everyone to really follow the economic plans put forward by the Central Committee and do a good job in the next few months. But when compared to earlier, stronger statements about meeting growth goals, his use of phrases like strive to complete the annual economic goals sounds pretty weak. It sounds like not even Xi is sure that the economy will grow by the small 5% goal. A lot of people also think that the government might use more economic measures if China can't meet this low bar. In other words, the government might take more steps to try to fix things if the economy doesn't get better as planned. The fact that Xi Jinping spoke at this time probably shows that the economy has been weak over the past few months. Lin Song, who is the head economist for Greater China at ING Bank, thinks that Xi's comments will lead to more urgent policy support. This could mean that we soon see a bigger boost from that side. That's what usually happens. When China's economic numbers are bad, more aid is talked about. Then, the government spends more to try to meet its growth goals. This causes prices for copper and other commodities to temporarily go up because people are hoping that this time the stimulus will work. But here's the catch. These short-term boosts don't usually turn into long-term gains. It's clear that the stimulus didn't really fix the problems that were there to begin with after the original excitement wears off. Instead of improving market mood, these quick fixes don't do much for the real economy. Even though copper and steel prices have gone up a bit and back down again, they're still a long way below where they should be. This time, people are hoping that Beijing will make a brand new, smart plan that will work out just fine. But it's not likely that this will happen. Since the bond market keeps going down, interest rates are also going down. People often think that low interest rates mean that people want safety and cash more than they want to see signs of economic health. They show that people don't think growth will happen, or that growth could even go down if things go really badly. Even though everyone wants a magic bullet, the real problems may not be so easy to solve, and the world economy may have more problems in the future. Let's break it down. There are signs that prices will go down, which is in line with what the bond market has been saying all along. A lot of people are curious about why China's bond market doesn't have the same downward curve as those in the US and Europe. The Chinese system works in a different way, which is why the Federal Reserve and the ECB change short-term rates all the time. The Chinese central bank, on the other hand, has been using the medium-term lending facility, MLF, as its main tool for a while now. The MLF doesn't really change the way the bond market works or the state of the economy. China has been paying more attention to the 7-day repo rate lately, but it doesn't change the general bond curve very much. Bond curve inversions usually happen when central banks change the short end of the curve, which makes market forecasts and central bank policies not match up. It's not been the same in China because they haven't had a strong interest rate policy up until now. Even so, China's bond rates are going down across the board. China's 10-year bonds hit a record low of around 2.06% to 2.07% this week. They were down from 2.18% at the end of August. This is important because bond yields are still going down despite all the measures taken by the central bank, including some harsh ones. In late July and early August, worries about safety around the world caused bond prices to drop sharply. Yields went up a little when China's central bank took different steps, but they never went up by more than 10 to 15 basis points. August turned into September, and the trend kept going. The yield on China's 10-year bond hit its lowest level ever. Some bonds are being sold by the Chinese central bank, but things are still very crazy. It was 1.7% this week, which is a new record low for the 5-year bond. The old low was 1.74% in April and May 2020. With a rate of 1.33% on Friday, the very important 2-year bond is also very close to a record low. It's just a little bit higher than the all-time low of 1.325% from April 30, 2020. What's interesting about it? The rates on bonds are falling to levels seen during the pandemic, but there isn't a lockdown or health crisis happening right now to cause these rates to drop. Instead, it's all about big-picture economy and money issues. The market isn't being shook up by politics as much as it was in 2020, but rates are still falling to the same levels. The central bank has been working hard to take over the bond market. The People's Bank of China, PBC, said they would short sell bonds a few months ago, but they never did. It was even said that they had recently borrowed hundreds of billions of dollars in treasuries from Chinese traders. Of course, it looks like the PBC has begun selling bonds, but not the ones they borrowed. In its place, they're selling other ones. At the end of August, China's Ministry of Finance repaid a large amount of debt. The central bank bought about 400 billion CNY of that from state dealers. Then, the PBC said it would sell some of these bonds on the market. China's government bond market has seen more trade, and this week, bonds with codes like 24101 were put up for sale. This makes it look like the central bank is selling longer-term bonds to try to stop the bond rise that is still going strong, even though they are trying to stop it. It all started when Chinese rural banks were told to cancel bond deals they had already made. Brokers were told they had to limit the bonds they sold and controlled, in a move similar to how the Red Guards were shamed and named during the Cultural Revolution. State-owned banks were told to name and shame people who bought a lot of government bonds. Rates have kept going down, even though many things have been done to stop them. The simple reason for this is that there is proof that what rates are saying is happening. Not only do rates show how things are now, they also predict that things might get worse. This is why the yields on Chinese bonds are closely linked to other financial measures, such as the ratio of copper to gold. The ratio of copper to gold is at a high that hasn't been seen since 2020, 2016, and 2008, 2009, all of which were tough years for the US and the world. So, it makes sense that the prices on Chinese bonds are matching up with these signs, since they all point to the same thing: financial stress. There are also strong signs of decline around the world. Other financial measures and US dollar swap spreads are also at all-time lows, which makes these deflationary trends even stronger. Bloomberg reported last week that the Chinese government has been trying to boost industries like making electric cars and green energy, but these are now showing signs of economic stress. A study by Shane Insight Group and business big data company found that entry-level pay dropped almost 10% in August compared to their highest point in 2022. 300 business leaders were polled by the Chong Kong Graduate School of Business. The results showed that labor costs rose the least last month since April 2020, which is often used as a benchmark. That's when China's first COVID lockdowns began to loosen up. A different set of data from Joe Pin Limited shows that in 38 big cities, the average hiring salary barely changed in the second quarter. This is very different from the 2 years before the pandemic, when growth was only 5%. The People's Bank of China, PBOC, polls customers every 3 months and finds that income levels are back to where they were during the lockdowns in 2022. At the same time, job prospects are even worse than they were during the lockdown, even though there were no lockdowns in 2024. This means that Chinese investors are probably more worried about their jobs and income than they were during the lockdowns. People, companies, and banks in China all seem to be getting more and more worried about the economy. The most recent numbers from the PBOC's financial report and total social financing figures show that this is a concern. Banks are focused more on buying government bonds for safety and liquidity and giving out as few loans as possible, which is a classic sign of deflationary strategies. In August 2024, there was a big drop in the total sum financing to the real economy. This includes bank loans as well as equity, bankers' acceptances, and new government bonds. It was 3.03 trillion RMB in August, which was less than the 3.13 trillion RMB that was moved in August 2023. In July, rates on RMB loans, which are a part of social financing as a whole, fell to their lowest level in 15 years. You may remember that I talked about this in a previous video. Credit tends to drop in July, but it tends to rise again in August. But not this year. The study shows that there were only 900 billion RMB in new loans in August. This is down from 1.36 trillion RMB in August 2018 and 1.3 trillion RMB in August 2019, both before the pandemic. It hasn't been this low since August 2016, when it was 900 billion. As you can see, banks are being very careful by only giving out small amounts of loans. The financial data report from the PBOC shows that the stock of outstanding RMB loans grew by only 8.5%, which is another record low growth rate. In August, household loans, which includes mortgages, went from being down by 210 billion RMB in July to being up by 190 billion RMB. But this still shows that family credit and real estate have done poorly. It's not a surprise that bond prices are falling to all-time lows, given how things are right now. These low yields show that people are worried about both the present state of the economy and the risks that might happen in the future. China is still having a hard time with falling wages, high unemployment, and low incomes, according to the bond market. The way things are now really fits. Prices for both producers and consumers are beginning to fall. It doesn't look like the GDP deflator will change anytime soon, since it has been negative for 5 quarters in a row. Bonds are showing that these trends are real. Even more telling is how the banks in China are responding. Bonds are being bought quickly, but they're not giving out much new credit. They are very selective about who they give money to, and only to their most reliable customers. To be safe, there should be low growth, low hopes for inflation, and maybe even negative growth and falling prices for goods and services. Rates are going down everywhere on the bond market to show that people are being cautious.